Imagine two identical twins, Mark and Dave. They are 30, earn a $75,000 salary, and live in identical houses next door. On paper, their financial lives are indistinguishable. Yet over the next 30 years, Mark is going to pay $250,000 more than Dave for the exact same life. He is handing that money directly over to banks, landlords, and insurance companies. This massive wealth transfer happens because of a secret 3-digit number attached to Mark's identity. His score is 640, Dave's is 760. We treat this number like an ancient constant, but the FICO score was introduced in 1989. It is literally younger than Taylor Swift. This corporate invention standardizes risk so the banking industry can efficiently package and sell consumer debt. On a $400,000 house, a 760 score gets a 6% rate. A 620 score triggers 7.5%. That gap adds $120,000 in interest over a 30-year mortgage. Diverted into the S&P 500, that money compounds into $500,000 by retirement. A low credit score destroys your long-term wealth, siphoning your retirement savings directly into the bank's earnings reports. The algorithm has mutated into a universal reputation check, used by landlords, by utility companies, and even employers during background checks. Auto insurance companies use the score to set premiums, often charging a safe driver with poor credit twice as much as a driver with a DUI and a perfect 800 score. The system ignores actual liquidity. A person with millions in cash and no debt history registers as a ghost, an unscorable entity with no value to the algorithm. Financial independence is penalized. Paying off a car loan often causes a score to drop immediately. The algorithm functions as a loyalty program for debt, rewarding those who stay trapped in a continuous cycle of interest payments. Understanding the specific mathematical rules of this game allows you to exploit its inherent loopholes. Look at credit utilization. Spending $500 on a $1,000 limit creates a 50% utilization rate, which the algorithm views as desperation. By increasing your limit to $10,000 while maintaining that $500 balance, your ratio drops to 5%. The authorized user hack allows wealthy parents to copy-paste 20 years of perfect payment history onto an 18-year-old's report, giving them a top-tier score before they even earn their first paycheck. For those with damaged credit, the Fair Credit Reporting Act provides the legal leverage for repair. The law requires creditors to provide verifiable, flawless documentation for every mark on your report. If they fail to produce accurate records within 30 days, the Bureau must delete the debt from your history. Savvy borrowers treat these legal loopholes as essential tools for protecting their personal wealth from an aggressive system. Many financial gurus advocate for a cash-only lifestyle, encouraging followers to abandon the credit system entirely. Opting out of the matrix creates massive financial friction, forcing you to pay higher security deposits and face constant rejection from housing and employment. The pragmatic path is to dominate the algorithm. Automating your minimum payments secures the 35% of your score tied to payment history, ensuring one mistake doesn't haunt you. You can dilute your utilization by requesting limit increases and preserve your account age by keeping oldest cards active. This score is a tool for accessing cheap capital. By manipulating the algorithm, you become unprofitable to the banks in the short term, ensuring you keep that $250,000 for your own financial freedom.